Hello and welcome to the Mutual Fund Show on NDTV Profit. I'm your host, Siddharth. As always, we'll try and bring you some key actionable points. We'll try and address some of the queries as well, and we'll try and talk about a couple of topical points when it comes to the markets. Our guest today, Kshitiz Mahajan, Managing Partner and CEO of Complete Circle Wealth Solutions, and Siddharth Srivastava, Head of ETF Products and Fund Manager at Mirae Asset Investments. Gentlemen, both of you, thanks so much for joining in. We want to start off by talking about momentum funds, and one of the reasons why we're also doing this is because Mirae is going to be launching the Mirae or has launched the Mirae Asset Nifty Mid Small Cap 400 Momentum Quality 100 ETF. Okay, that's a long name, but it's a simple product, I guess. And let's try and understand the product and what kind of investors should go for it and whether or not you should go for it. So, of course, Kshitiz, I'll urge you to play the devil's advocate here when you do. But I'll start off the conversation with Siddharth. Siddharth, what's the rationale for launching a fund of this nature in the current investment climate?
First of all, while there are 56 mid-cap and small-cap funds have an AUM of roughly 5.6 lakh crores, there's no category which takes care of mid and small cap together. So the category does not exist on the active side. Hence, no fund focuses on mid and small cap alone in a focused manner, and there's no fund which targets mid and small cap together on the passive side also. So the idea was to create an offering which can provide exposure to mid and small cap segment at one go. So this particular fund will select 50 mid cap stocks and 50 small cap stocks in the 100 stock portfolio. And the rough allocation from a weight point of view will be 70 to 80% towards mid cap and 20 to 30% towards small cap. The idea is to add sorts of small cap flavor without sorts of increasing the risk profile of the fund too much.
Mm-hmm. But so is there a methodology, or does it passively follow a particular selection? Give us some details about this aside of just the pure allocation between mid caps and small caps, Siddharth.
Yeah. So basically you mentioned that momentum funds are getting very popular, right? And these funds tend to work well during bull market, but may suffer during bear market, because ultimately you are sorts of investing in stocks which are doing well, and these strategy-based fund may underperform significantly when there is volatility. What we try to do here is to create sorts of an all-weather portfolio, and we are trying to achieve that by picking out stocks based on quality metrics also and momentum metrics also. So all the mid and small caps will first be filtered out based on liquidity parameters, whichever is thinly traded, whichever has high promoter pledging, very less listing history, too many stock circuits, etc. And then remaining mid and small cap stocks will be assessed on both quality metrics, which is profitability, earning stability, low leverage, as well as momentum metrics, which is risk adjusted performance. And whichever does well on both will form part of the portfolio. Now, the idea is to, in a way, capture the upside using momentum in bull market and sorts of continue providing portfolio stability when market is volatile or market is in correction mode. So that is what we are observing when we have backtested the strategy. The NSE has backtested the strategy since last almost 19 years. And that's the kind of behavior these funds exhibit. A bit of momentum capture in bull market and portfolio stability during volatile markets.
Kshitiz, coming on this, one, the nature of the product focused on mid caps and small caps at a point of time when everybody's saying that large caps are cheap and mid caps and small caps are not, part one.
Right.
But part two, in a good market space, momentum funds tend to do very well. Momentum strategies tend to do well. Forget funds, sorry. I mean momentum strategies. Not necessarily the most tried and tested strategy per se for investors. How good or bad would a strategy like this be for mutual fund investors? What kind of investors should go for it? And another point is people talk about whether products like these have liquidity issues or constraints. Is that something that you take into account as well?
Yeah. So, Neeraj, first of all, coming back to that, what type of client should look into this type of strategy? So, we have three questions. So, first, I think this can be a tactical allocation in client's portfolio, because momentum strategy played well really in last 3 years because the market's been doing really well. And it has to do with markets, that markets have done well because momentum strategy basically works on technical charts. It works on various metrics like moving average, RSI, and then depending on what type of upside momentum there in the market, then you pick the better ones in that momentum. Let's say it's a broad-based rally, but then you see there's a rally. Let's take for last 1 year example was in PSU or defense sector. You have picked that stocks. So out of the 400 stocks, let's say you take that 100 part of the stocks, but it has already rallied too much, small cap and mid cap sector. And I have nothing against this strategy, but it's little or maybe the most high on the risks reward metrics in terms of as we speak now. So I think one is that. Second is if somebody want to take allocation, it can be 5 to 6% allocation in these type of strategies. Third, when you talk about the liquidity part in ETF specifically, we don't have that depth in the market in India. Still, the basic mode of investment is through mutual fund route or index fund route, where you don't have the right market makers, because market maker makes that ETF pool and through which you can buy or sell. But a good part about Mirae is they have their own Mirae Capital, which they have their own market maker. So there, the money which you pay or premium which you pay when you sell your units is quite less, and it's very much in that affordable range where you don't lose on the return. Then in few ETFs, why the cult is not increasing in India is because market maker is charging a lot, because not many people are coming. Because in the normal mutual fund you don't have to open a demat account, but when you go for an ETF, you have to open a demat account. That's the difference. So I think that this type of strategy is good when the markets is doing good, but it can't be your core strategy. It can be a tactical strategy. And I think on a broader market basis, if you're playing momentum and quality both on small and mid cap at these levels, it can be little riskier. But yes, I think I'm sure Mirae has its own plan. They must be staggering and looking at a better side of the portfolio. So they must be looking at the quality aspect also. So they have both things going their way.
Okay. Siddharth, coming on this point, one, the liquidity aspect for ETFs and what's your response there, part one. And two, something that I highlighted at the start and Kshitiz referred to as well, right? It's the point of time in the market wherein valuation wise, large caps are considered the most attractive relative to mid caps and small caps, wherein at least at the mid cap end the valuations are high. And I heard you say that 70% of the portfolio might be in mid cap. So why the timing of this one particularly?
That is the most. So I'll address the valuation question first, because that is obviously the most talked about part. So see, there is froth and stocks are overvalued, not only mid and small cap segment, but large cap segment also, right? There are companies which have very frothy valuation in all the three segments. While on an overall basis, yes, large cap looks more reasonably placed from a valuation point of view. And that is why when we are going out and we are talking about this fund, we are saying that if your investment horizon is 1 to 2 year, do not invest in this fund. But we believe from a 4 year, 5 year plus point of view, small cap and mid cap will give pretty good returns, pretty reasonable returns. So our communication is pretty straightforward. Do invest in small and mid cap only from a long term point of view. For short term, 1 to 2 year, stay in large cap segment. But then again, no one can predict the market, right? In last 2 years, our other market expectations regarding US, regarding Fed rate cuts, regarding how small and mid caps will perform since 2023 have been sorts of not proven right. So it is best to focus on asset allocation and stay invest for the long term. Now, when it comes to liquidity, of ETFs on exchange. Like the gentleman mentioned, we have our own market maker, which is Mirae Asset Capital Markets, who provide liquidity in our ETFs on exchange at all times around the live net asset value. So in our case, typically investor will be able to invest at right prices and redeem at right prices on the exchange.
Siddharth, take a moment to thank you for joining us and explaining the details of this ETF, and wish you guys at Mirae all the best for this product. We've heard the Prime Minister speak about how he wants to make India the hub of manufacturing. We've seen manufacturing practices improving. Companies globally talking about setting up shop in India. How do you take advantage of that? Well, you and I can't invest in a company or buy out a foreign company coming in and setting up shop in India, but we can invest into funds which are investing into manufacturing. And you will ask, are there manufacturing funds? Yes, they are. There are in fact now a slew of fund houses which have got a specific manufacturing fund, from a Quant to a Kotak to ICICI to HDFC, a clutch of names out there. Question to you, Kshitiz Mahajan. Should people choose manufacturing funds and invest in them? Why or why not? Should they be a part of core or satellite portfolio? Normally people might say satellite, but in the current India, do they become a part of core as well?
So I think this is one of the good questions which have come across in recent times. But you asked me, this can be a part of your core portfolio. Although it's a sectoral approach which when you buy a manufacturing fund. But because if you align your entire goal or your wealth planning with government focus right now, what it is, which is they're saying that, as you said, that 25% of the GDP contribution should come from manufacturing by 2025. We are around 18% right now. And you see PLI for 14 sectors. You see global giants coming to India. It doesn't only bring global money, your foreign currency, it also creates jobs also. So I think that clear-cut focus is there. And I'm not talking here about that we are competing here with China, but there is enough room, or let's say there is enough demand from your domestic population only. We have a population of 140 crore plus people. So I think it can be a part of your core portfolio, and eventually, I'm not saying other sectors will not do well, but yes, there's a clear-cut scope. Wherever you are meeting promoters, we are going and visiting plants, we are meeting promoters, we are meeting their manufacturers, their buyers, suppliers, vendors. Everybody is talking about expansion. They are doing capex. You meet more people than what I meet, but I'm telling you that clear-cut focus is there. That boss, yes, we want to multifold our capacity, how we can grow, and obviously there are certain gaps which we need to plug. But yes, one can look at making manufacturing fund as a part of the portfolio. I'm not recommending here any fund or any new offering, but I'm saying that this can be looked at clearly from a point of that boss, eventually this entire theme will not only create some growth for you in your wealth portfolio, but as a government also, if you see, we have to focus on manufacturing for carving out new jobs, for getting foreign currency, for getting the bigger picture in place. So look at that number, keep that number in your radar, that 25% overall GDP will contribute, and they are very much on line with that.
Okay, very quickly, Kshitiz, if you had to put in a fresh portfolio right now for yourself,
right,
what percentage of your portfolio might go into manufacturing?
Pure manufacturing, because you have
manufacturing funds, I mean.
Yeah, pure manufacturing, I think 8 to 10% is what one can look at.
8 to 10%?
Yes, one can look at right now putting in manufacturing fund. And at these level, again, my way of doing it, if I have to do a lump sum investment, I'll do 8 to 10 weeks staggered investment.
Okay.
And if I have to do SIP, that's the right thing to do about it.
Okay,
yeah.
Okay. So, viewers, Kshitiz Mahajan doesn't shy away from putting in 8 to 10% into a manufacturing fund, because that seems to be the clear focus. I mean, look at defense, look at railways, look at anything else, and there's manufacturing right up there. So that's an important point that you should keep in mind as well. Now, before we wrap up the show, some queries. It's an important part of our show. Let's get in the first query in. The queries come in from Kiran. Kiran is 42 years of age. And the goal is 1 crore, I believe 1 crore corpus. Now, Kiran says, Kshitiz, that, sorry, I don't know whether Kiran is a he or a she, but I'm going with a she. So Kiran says that she has a 7,000 rupee SIP in 3 funds and wants to invest 20,000 rupees additionally in monthly SIPs, I presume. Can some funds be recommended? Current funds are Quant Mid Cap, Quant Small Cap, and Parak Parik Flexi Cap.
So, good part is that she can step up her SIPs by 20,000, so that worked to be 27,000 almost. And eventually, if she can just step up by 3,000 more in next year, because as and when your income will grow, at 30,000 monthly SIP over next 2 years, if we see that the way things are going, and if her portfolio can grow at 14.5-15%, she can have, by the time she's 42, by the time she'll be 57 or 58, she can have 2 crore rupees on her side. That's the power of compounding for you. A simple rule of 15, it says 15,000 rupees SIP for 15 years at the rate 15% will yield you 1 crore. If you are doing 30,000, then it can give you around 2 crores. So funds little aggressive and it looks good. A couple of funds looks good because markets have done well. My request or suggestion, or let's say if I would have been in that place, I would like to add a couple of flexi cap or multi cap fund which have little inclination or little more inclination toward large cap side at this level. So I think that's one should look at.
For example, sorry, I mean just.
So
not recommendations, but
so
just
I have in my personal portfolio SBI Contra, HDFC Focus. These are my personal 2 funds which are there in my personal portfolio. I don't want to recommend anyone, but these are my personal portfolios. One can look at a FlexiCap fund, ICICI FlexiCap fund also. They have good fund. Nippon Focus is good fund. So one can look at Mirae has a good focus fund, which has not done well, although the top holdings have been good. So one thing which we always look at the past performance, but look at the portfolio which can do well from here onwards. As you said before the break also, many of the large caps are lagging behind, and many of the banking as well as many of the stocks have not got their due as per the earnings. So I think one should look at these type of portfolios and just add, because you already have small and mid cap exposure in couple of funds, just add these 2-3 funds.
Okay, and just very quickly a follow up. For her age at 32, such a risk appetite and aggression is fair, right? I mean,
yes,
you can be aggressive at this age. Maybe you can't be aggressive when you're 60, but at 32 you can be this aggressive.
Yes. So my mistake. I thought she's 42.
Sure, 42. But 42.
Yeah.
42 is the new 32.
Yeah, 42 is the new 32. So I think it's very much she can do this. She can actually add flexi cap and multi cap fund. Problem today is that if you're not in equity, that's a bigger problem than being in equity.
Yeah.
Because eventually, if you want to beat food inflation of 7.5-8%, it's only equity which can beat that inflation.
Most certainly. Okay, Kshitiz, thanks for that. Okay, and Kiran, well, you won't mind. I called you 32, which is great, right? I shouldn't call you 52, simply put. Okay, the second question is from Suhas Kothari. Suhas is 35 years of age. The goal is a retirement fund. Suhas says, I have SIPs in 5 funds and would like to stop SIP in 2 of the different funds. What should I do with the balance amount? Move to a different fund via an STP route or otherwise? The current investments, Kshitiz, are PPFAS, ICICI Multicap, HDFC Midcap, Nippon India Growth, and Nippon India Small Cap Fund. Let's keep these on the screen. And Kshitiz, now out of these 5, he wants to stop 2. So
all funds are good funds. My sense is, the more you'll be there in these funds, you'll see multi-bagger effect coming in your portfolio. Reliance, if I'm not wrong, Reliance Growth Fund, which is there in that fund?
There's Nippon India Growth, yes.
Yeah. So I'm thinking this fund has more than, if I'm not wrong, this is the same growth fund which has more than 2,000 NAV. It has gone more than 200 times. So point here is you have to give time to your investment. So there is no need to stop. All these funds are good funds. Just keep on doing. STP is not meant for your monthly investment. It is meant for your lump sum investment. If you have some lump sum money coming your way, maybe a bonus, some proceeds from some land sale, some other thing, then you can do STP. Otherwise, please don't stop your SIP, because SIP can actually average out your overall return. Let's say if you're expecting markets to fall also, you can get some units at a discount also. So these funds are good. I had been, these funds are in my portfolio. I would not like to stop my SIP.
Okay.
Yeah.
So and I think the follow-up is that, and maybe I stand corrected. Suhas wants to stop SIPs in the following funds and needs advice with the current balance number. So Kshitiz, so I stand corrected.
Okay.
The ICICI Pru Blue Chip Fund, if I'm understanding this query correctly, ICICI Pru Blue Chip and HDFC Top 100, Suhas seems to have taken the decision that wants to stop the SIPs in these 2 funds. Assuming that the decision is taken.
Right.
Wants to know what to do with the balance of these funds. Should he invest in those 5 funds or should he choose some other fund?
So Suhas, the cost of switching these funds is first of all the capital gain. You're too young. So you pay 10% capital gain. If you think that another fund can actually give returns which are more than these funds as well as can take care of the capital gain part, only then switch. Otherwise, just keep the amount in these funds only. If you want to shift from SIP part, that is understandable, that you don't want to go with the large cap, you want to have a multi-cap approach, then you can have a flexi cap, a multi-cap, couple of funds added to your portfolio, but keep this amount in these funds only, because large caps, as you said, as we believe, are about to do good from here onwards.
Okay. So sorry I botched up the query the first time, but I hope you got your answer now. And Kshitiz clearly believes that you don't need to. Also keep in mind, even if you've made a decision that no, you want to, independent of what Kshitiz just said, please do examine the tax aspect that Kshitiz was talking about, because when you sell these funds, you will incur a tax liability, which you will have to pay, and then the balance money goes into some other funds. So please do consider that when you're making the decision. But Kshitiz, take a moment to thank you for joining us in our studios today. Lovely having you. Great meeting you.
Thank you for having me.
Thanks for taking the time out.
Thank you very much, Neeraj.
Pleasure was ours. And viewers, thanks for tuning into this edition of the Mutual Fund Show.